A manic Monday in the markets. How's that for an alliteration? Joining us tonight, the president of Heartland Investor Services from our Bismarck studios, Eugene Grainer. Eugene, thanks so much for joining us, sir. I guess let's start here. Let's talk about what this means really for the average investor. You've seen over the past couple sessions, markets down over 500 points. Is this just kind of a typical correction, or is there a bigger picture that the average Joe investor should be aware of here?
Well, thanks for having me on first, Chris. This is a little bit more of a structural change. This isn't your typical blip in a correction in the stock market. This is kind of a changing of the guard right now. We've had a stock market that for many years has been floating on air, an economy that really hasn't supported the PE ratios, the valuations that a lot of stocks have been carrying, because the point is, where were you going to go with your money? Interest rates were so low, CDs paying nothing, that even people in the age of 70 were trading stocks that they necessarily, we would have taught, 2 decades ago, they should be mostly in bonds. Well, bonds weren't paying anything. So we have a market that was basically floating on air, so to speak, and the Federal Reserve has been talking about interest rate hike coming, and they've been doing this for 2 years, and they've picked up the rhetoric more here in the last 6 to 9 months. And of course, that is part of what caused oil prices and commodity prices to decline in the last half of 2014 into 2015 was this strengthening U.S. dollar. When you raise interest rates or anticipate raising interest rates, your dollar firms up. And of course, it's been creating these currency crises that we've been experiencing. Now, what is happening today and what's affecting the average person is that China started stumbling weeks ago. Their economy is continuing to slow, and they're becoming a drag. Now, remember how years ago you probably heard the statement, when the U.S. catches a sneeze, China got a flu. Well, now, because of what the central banks have done over the last literally almost a decade, since 2008, we've almost intertwined each other. We're webbed together. So one country just doesn't stand alone so much as a lighthouse, while other countries fall apart. We kind of all fall together, it seems like, rise and fall. It's like this one world economy they've always talked about. Well, the central banker dream is somewhat, happening to this. And so as China has stumbled so aggressively, much more percentage-wise than we have dropped, we've now started catching this drop. Now, when people say, it's just a correction, not necessarily, because typically when we go into this time of year, August, September, October, if you were to read about historically all the problems we have in stock markets, they typically occur September, October. Remember 2008 crisis?
Yes.
Started in August, magnified in October. The average 401k in October of 2008 lost 25% of their value in 1 month. People were upset and mad, and an individual was saying, change and hope, we'll do better. They said, okay, let's give it a try. And that's what brought about the Barack Obama presidency. But nonetheless, as we back up, this is not as much of a correction as it is transitioning from easy money to potentially a quarter-point interest rate hike here coming up in September. Now, many are saying that the Federal Reserve, in the current environment, may have to choose to delay again. But the problem is the Federal Reserve is painting itself in a corner because it said everything is so good. The macroeconomics, they're coming around. They're starting to hit measuring marks that they've wanted to see. They have a strong economy. And most importantly, it's to save face. And when they have spoken something for literally 2 years now that they stated they were looking at trying to normalize interest rates, and you don't have an economy that after delaying for 2 years can't even take 0.25% interest rate hike when we're literally at zero, mortgage rates, as cheap as they are, loans that you can get for 4.5%, we can't take 0.25% interest rate hike. That says there's something deeper.
Well, and Eugene, you're getting at something. I want to get to 2 more things here. We got just a couple minutes. So one is when you see China devaluing their currency, many people are saying that could create deflation here in America. One, number two, that they're starting to position themselves to potentially become the reserve currency of the world. Do you see that to be true and accurate?
The devaluing is basically, they're following our playbook. When our economy stumbles, we devalued our currency by printing more money, changing their lending rates. China is just doing exactly what we did after the 2008 crisis. So if their central bank is modeling our central bank, who are we to judge them on that aspect?
But my question is, are they making a move to create a currency war to potentially become the reserve currency, in your opinion?
Yeah, they really can't create a currency war because the yuan is pegged to the U.S. dollar, and it trades inside of a band, and that band they adjust. And so a currency war is not necessarily started the way the stock market is moving right now. That is something where they're trying to back with Russia what we call SPRs. And so they're trying to create this secondary reserve currency through the SPR effect through the World Bank. That's how they want to take away our world currency status. Whether they can do that or not is, again, open to debate. But the current environment that is happening, this isn't part of creating a separate world currency, because the point is they're just using our playbook.
Right, which obviously they can then export more of their stuff because the goods are cheaper to get out of the country and whatnot. So here's what I move on to this. When you look at North Dakota, today oil closed at levels of February 2009. I think it closed at 38 something. Correct me if I'm wrong there, but you and I talked off the record a few weeks ago, and you said, Chris, I think by January of 2016 or so, we might see oil in the 30s, which made many people go, whoa, what are you talking about? That happened today. My question to you, when you look at North Dakota's budget, 80% of K through 12 spending, taking over county social services, with oil at these price levels, how long will they stay there? And if they stay there for quite some time, can North Dakota continue to fund its budget at these current levels?
Well, unfortunately for our politicians, and I did say whenever they said it was a blip, I said this is not a blip, just like I used the word structural change because of what the U.S. dollar was doing. This is a deflationary event. When your currency strengthens, it puts downward pressure on your commodities. Now, I will admit that crude oil, I thought we'd probably be later into the winter when we'd probably see crude oil in the 30s, but it's accelerating itself. We've had a demand base domestically that has not been as robust as one would expect. Typically, we would pull 7 million barrels of oil out of storage in addition to our imports and our own production to meet weekly demand. We've been off and on either pulling oil out of storage or putting oil in storage in summer months, which is just a testament of what trouble we have lurking. Is one of my statements I've said, the story that you're going to carry come December, January, or February, pick a month, write this down. We're going to be talking about how oil wells in North Dakota are going to have to be shut off, because there's no place to go, because the storage that we typically fill up in the wintertime and draw from in the summertime are going to be full. So unless you have commitments that are being made, rail traffic that you can get on, our 1.2 million barrels a day will have to be restricted. And this happened before. This is historical. In North Dakota in the 1950s, the state had to limit some oil production because the inability to move it or store it. So history has a funny way of repeating itself, a different twist every now and then, but history says we may run into a situation where this fall we're going to have to restrict oil production in North Dakota, if not produce it, as wild as that sounds. Now you ask, how does that affect, you know, the taxpayer and such? As you know, the excise tax, or the tax that we take on the oil, we're only using a certain, I think it's about $300 million a year, and the rest goes into our heritage fund and such. But it's the retail sales, the income tax that the state's been thriving on and spending and doing the kickbacks to real estate. Eugene, they're going to have trouble maintaining that kind of real estate kickbacks.
That's exactly it. Eugene Grainer, thank you very, very much. Check him out at heartlandinvest.com. President of Heartland Investor Services. Always great insight. Obviously, you can see what's going to happen here possibly in December, January, and February. Stay with us when we